Alright, good afternoon guys. So like I said, I will be posting up a video daily depending on if I see a trade or not in the London or New York session. So I actually didn't trade at all today because I normally trade London and I didn't have no good setups, but New York did present something. So I'm gonna break it down for you guys and explain to you guys a couple of things that go through my head while I am trading. So I was expecting lower pricing from here, but as you can see, the market actually printed a bullish candle on the DXY. Now keep in mind the DXY is the inverse of EURUSD and GBP USD. So when a bullish candle or an up candle prints on the DXY, you're gonna see a down candle printing on Euro and GBP USD. Okay, so the meat of the setup really came from Euro USD. So since I was waiting for the DXY, I actually wanted to sell off. I was looking for Euro USD to buy. So I'm gonna show you what I was looking at during New York session and what you could have potentially taken if you use my model. Okay. So first of all, I want to say that the very first thing that I look for in a trade is a liquidity grab. So the liquidity grab needs to happen after 7 a.m. and before 10 a.m. So it's within your kill zone time. New York kill zone time is 7 to 10 a.m. That's the ICT New York kill zone, and this is the time that I operate with whenever I'm trading the New York session. So as you can see here, you have the little X. This is where price initially took liquidity. And the reason why I view this as a liquidity grab is because price traded below a short-term low which was created after 7. Now the short-term low doesn't need to be created after 7, but wherever it is, price needs to trade whenever it's bullish. Price needs to trade below a short-term low before breaking to the upside, so I can potentially look for any entry. So these are two things that I need in an entry. Now, I also want to talk about the concept of discount and premium. Now, the foreign exchange market is like going into a store. So whatever you want to buy, you normally want to buy things that are on sale or on a discount, and you normally want to sell things when the price goes up, so when they're at a premium. So the foreign exchange market is the same way. You normally hear the term buy low, sell high. Now, I'm going to show you exactly what that means. Now, buying low and selling high may be objective. So when I'm looking at buying low and selling high, I'm looking at the current price legs and where price is currently and what I'm expecting because I'm trading the daily range. Okay. Now, where we have the entry, where you see this arrow here, you see I have a what you call a Fibonacci tool. 50% below 50%, I have this golden line. That's a fair value gap, right? Now, the reason why the market bought from below the 50% is because the market came back into discount, and that is the algorithm working the market in its favor. So in order for the algorithm to add more buys into the market, they would first run out the early buyers, which is right here. So they took out anyone who's buying, got stopped out here, right? Then anyone who was selling got stopped out here when they broke structure to the upside. Now they retrace back into a discount so they can continue buying, and then they took profits up here and sold off. Now I'm gonna explain to you why they took profits up here. So it's really the same concept, it's discount and premium. So as you can see, I marked up the entire leg going down. Obviously, my personal overall target would have been to take out these highs. These are actually London highs. My overall target would have been to see the market take out these highs. But when trading, you have to be prepared for anything because you are a spectator. The money that we put into the market doesn't affect anything. The millions and billions of dollars that is run by the algorithm, by the central banks, by these big players is what really makes any dents in this market whatsoever, right? So now you can see here that the first partial would have been taken in a premium because the market now retraced to above the 50% level and then into this fair value gap. Now you may be wondering what's a fair value gap because I keep on saying it over and over again. Now an ICT fair value gap is a place where the market is inefficient. Now for the market to be efficient, it has to offer the price, every single price, to both buyers and sellers. But then when the algorithm and the big banks do the heavy-handed movements, like right here, you see that you have a very heavy-handed movement, very big candles, and you don't see anything really retracing back into it. This is what causes a fair value gap. Right? If you really want to learn more about the fair value gap, you can go over to my mentor's channel, and he has an entire mentorship centered around entries and techniques with fair value gaps, right? Now, here we can see I have a couple of the things outlined for you. I have what you call a SMT divergence. Now, this is something that's very, very powerful and something you could look for whenever you're trading. Now, if you trade one pair, I would suggest that you look for a pair that is correlated with your pair, just so you can look for these signatures in the market, these smart money signatures, the SMT divergences. So let me show it to you over on GU. Now on GU, you can see this is the exact same time. It's 8:10, right? And the market went lower. But on EU, as you can see, the market refused to go lower. So this is signaling to you that EU does not want to go any lower. It actually wants to go higher, which makes it the stronger of the two pairs and is the one that's more likely to rally. Right? So in this case, you could have taken the trade. The trade was present on both EU and GU, as you can see here. The market went up and then came back down into this fair value gap, then we rejected. But as you can see, the market failed to get above this high because GU was weak. It was the weaker pair for selling. But over here on EU, you can see that the market did trade above. The market got into premium, and then it sold off again. This is one of the main signatures of the market makers. So everything has to be efficient. So whenever we're trading the market, we're looking to trade inefficiencies and target inefficiencies to then establish efficient price action. We're not looking to buy the market as the market goes lower. We're looking to buy the market as the market is preparing for a bigger buy. Okay, so this is all I have for you guys today. I hope you learned something from it. We're gonna close it off here.